So you're in your 40s and you're thinking, am I late to the investing party? Let me tell you, you are definitely not alone. The big question on everyone's mind is, can you still build real, significant wealth? And the answer is a huge, resounding yes. But, and this is a big but, the way you do it has to be different. In this explainer, we're going to walk through the exact playbook you need.
So, what's our game plan? First up, we're going to get our mindset right with a new investing playbook. Then, we're going to get our hands dirty with a real step-by-step plan to build a 70 lakh rupee portfolio. I'll lay out the exact 40-40-20 blueprint to get you there. We'll talk about how to dodge the common mistakes. And finally, we'll completely redefine what winning really looks like when you're investing at this stage of your life.
Okay, first things first, we need a new playbook. If you're still thinking about investing like you're in your 20s, it's time for a really important mental shift. We are officially moving away from a growth at all costs approach to something much smarter, a strategy of growth plus protection. And this is probably the question that's been nagging at you, right? That little voice in your head wondering, have I missed the boat? Well, I am here to tell you, as clearly as I can, you have not. The ship has absolutely not sailed. It just means you need a different kind of ship to get to your destination. This slide just nails the whole idea perfectly. Think about it. In your 20s, you're in a rocket ship. It's all about aggressive growth, shooting for the moon. And if things get a little turbulent, who cares? You've got decades to recover. But in your 40s, the game is completely different. Your new mantra, your new North Star, is balance and protection. So what do we actually mean when we say protection? It's really simple. It just means that the money you've already worked so hard for, keeping that safe, becomes just as critical as growing it. And why? Well, just look at your life. Your kid's education isn't some far-off dream anymore. It's getting close. Retirement isn't a vague concept. It's on the horizon. You just don't have the same amount of time to bounce back from a big market crash, so we need to build in some really good financial shock absorbers. Okay, so all this theory is great, but how does this idea of balance and protection actually turn into a real-world plan? Let's get specific. We're going to map out a realistic path to a really significant goal, building a 70 lakh rupee portfolio. To make this really tangible, let's picture someone. Maybe this person is you or someone you know. You're 43 years old, you've got a good income coming in, say between 1.2 and 1.5 lakh a month, and you're keeping your expenses around 70,000. See? We're not talking about some fantasy billionaire scenario. This is a very relatable, very achievable starting point. Now, with that kind of money left over, starting a systematic investment plan, an SIP of 20,000 rupees a month, is a fantastic first step. So let's run the numbers. If you do that month in and month out for 15 years, and we use a conservative, realistic return of around 10 to 11% a year, what does that get you? You are looking at a potential corpus of 60 to 70 lakh rupees. I mean, just let that sink in. That is a truly life-changing amount of money, and it's built from a single, manageable monthly habit. It is absolutely 100% possible. Now, I can almost hear what you're thinking. Okay, that's great, but can we do even better? Is there a way to put the pedal to the metal here, especially since I'm starting a bit later? And the answer is, oh yeah, you bet there is. The secret weapon is a powerful little tool called a step-up SIP. Think of it like a supercharger for your investment engine. You start with your 20,000 a month, but then every year, maybe when you get a raise, you just bump up that monthly amount by about 8 to 10%. It doesn't sound like a lot, right? But that small, disciplined increase, thanks to the magic of compounding, can add lakhs, sometimes even tens of lakhs, to your final amount over 15 years. It is the single most effective way to accelerate your wealth creation. So we have our goal, and we have our supercharger. But where exactly does all that money go? Well, that brings us to the blueprint, the 40-40-20 portfolio. This is the allocation model that's designed to give you that perfect balance we keep talking about. And here it is, the recipe in a nutshell. 40% goes into equity funds. That's your growth engine. Another 40% goes into hybrid funds. Think of these as the suspension on your car. A mix of stocks and bonds designed to smooth out the ride. And that final 20%, that's your stability anchor. Safe stuff like debt funds or fixed deposits. So why this exact mix? It's because at this stage of life, you just can't afford the wild roller coaster ride of a 100% equity portfolio. This structure is specifically designed to let you capture the market's upside while having a crucial safety net built right in. It protects you from those huge, scary losses that could totally derail your plans. All right, we've got our offense, the plan, the portfolio. but every good coach knows that defense wins championships. So now we've got to talk about what not to do. Let's cover how to avoid those high-impact mistakes that can really set you back. These are the 4 classic wealth killers for people in their 40s. First, just completely ignoring retirement planning. Second, the catch-up panic, where you get desperate and take on way too much risk hoping for a miracle. Third, and this one is sneaky, is not reducing your risk as your goals get closer. And finally, the set it and forget it trap. Not reviewing your portfolio is like driving without ever checking your mirrors or your gas gauge.
And this quote right here, it says it all. A big 30% drop in the market just hits different when you're 45 than when you're 25. The time you have to recover is limited, which makes managing that risk your absolute #1 priority.
This brings us to our final and maybe our most important section. It's all about how we think about this journey. It's about a new definition of success. You see, the most important change you need to make isn't in your bank account. It's in your head. Your new job is not to chase the highest possible returns. It's to focus on achieving the return you need to fund your life goals and to do it safely and reliably. It's a shift from speculation to strategy. And this is the line I want you to remember. Success isn't about bragging that you beat the market by a couple of percent. Success is being able to send your kid to their dream university. Success is retiring comfortably without financial stress. It's about funding your life, not winning some game. So, if you take one thing away today, let it be this. In your 40s, investing is a balancing act. Your job is to protect what you've already built while making sure it still grows steadily for the future. Not too aggressive, not too safe, but perfectly balanced. So now you have the playbook. The strategy is clear. The steps are actionable. The only question left is, what's your first balanced step going to be? And one final reminder, of course, this conversation is for educational purposes. All mutual fund investments have market risks, so it's really important to consult a qualified professional before you make any decisions. Thanks for joining us, and here's to your balanced financial future.